So thank you everybody for joining. I'm Sally Farrow. I'm a partner that heads up our private client team. So format is going to be normal. We're going to start off with the normal presentation. Jeremy Hunt yesterday framed his budget around the 4 pillars of his economic plan: enterprise, employment, education and everywhere. So we're going to take out the key tax statements that he made in his presentation and cover those. But we're also mindful that, as normal, documents are released after the budget, which contains quite a bit more detail and some provisions that weren't actually touched on. And also we had some big announcements in the autumn statement that take effect from April this year. So we thought it would be good to cover those as well. So we're classing that our 5th pillar, where we're just going to cover everything else that we think is relevant at this time, will be helpful to share with you. So I will be joined by 3 of my colleagues today. We're going to start off with Chris Richardson, who'll do a private client update. Dominic Carter will then give us a business tax update. And then finally, we've got Gillian McGill that will do an update on VAT issues. Some of you may have noticed that means we haven't got our normal employment tax update, mainly being because the budget was very quiet yesterday on employment taxes, so there wouldn't have been an awful lot for Tessa to cover. So we won't have a slot, but I will just mention next month we have got our employer bulletin that we will be sending out to everybody on our mailing list, which will give a helpful sort of summary and update on all employment tax issues. So if anybody doesn't think or not sure if they're on their mailing list, if you get in touch with us, I'll share a budget email address at the end. We will then make sure that you're added and you can get that employment tax update in written format as well. So if we just, and also I should say then finally we will have the Q&A. So if anybody's got any burning questions they want to ask us, we will do that. If we run out of time, we will promise to get back to you as well after the webinar if we don't cover them all today. So next we'll just do some housekeeping points. So you are all on mute. So if you do have those questions that you want to raise with us, if you can do that via the question box, we've got somebody who's going through and sorting those, and we'll deal with them at the end. As normal, we'll have interactive polls during the webinar. So we would encourage everybody to take part and answer those polls in each session. And finally, a copy of this webinar will be shared on our internet, but we'll also email a link out to those that have registered today. And we've also got a summary document of all the budget changes and new tax rates, and we'll share those with everybody afterwards and will be available on the website. Afterwards, if you think of a question that you haven't asked, or if there's anything you want to follow up, by all means contact your normal point of contact at Larking Gowen, or on screen we've got a special email address, budget@larking-gowen.co.uk. That's being monitored, and if you email there, somebody, the most appropriate person, will get back to you. So I think that's enough of the formalities, and so I will now hand over to Chris Richardson, who will do the private client update.
Thank you, Sally, and hello everyone. I work in the private client team and advise individuals and trusts on tax planning and reporting matters. The current pension rules have seen various changes since they were introduced in 2006, and this budget has been no exception. The lifetime allowance currently puts a limit on the level of pension funds which can be held by individuals, with a tax charge on any excess at retirement. That charge is currently set at 25% when the excess is drawn as a pension, or 55% when it's taken as a lump sum. This allowance has varied between £1 million and £1.8 million over the last 17 years, with the current level set at just under 1.1 million. One big change of this budget is that the allowance is set to be abolished with effect from April this year, removing limits on the amount which people can save into their pension funds. It has always been the case that those drawing a pension can take up to 25% of their funds as a tax-free lump sum. Despite the lifetime allowance being abolished, the limit on this tax-free lump sum remains at just under £270,000, being a quarter of the current lifetime allowance. Another allowance which has varied wildly since 2006 is the annual allowance, which restricts the amount of pension savings on which tax relief can be claimed. Once as high as £255,000, this allowance is currently set at £40,000, with potential restrictions to £4,000 for those with high income. The standard annual allowance is now being increased to £60,000, the equivalent to net pension payments of £48,000. Changes made 3 years ago increased the income threshold at which the annual allowance starts to be tapered away from £150,000 to £240,000, but left those with income above £312,000 able to save just £4,000 a year without adverse tax consequences. That income threshold is now being increased again to £260,000, with the minimum tapered allowance increasing from £4,000 to £10,000. The increased annual allowance also applies to those who are subject to the money purchase annual allowance, which applies to those who have already started to draw a pension in certain circumstances. This means that the minimum annual allowance of £10,000, equivalent to net contributions of £8,000, will apply for those with income levels above £360,000. The other change is for those on low incomes who are paying into a net pay arrangement by deduction from their salary. Such contributions are deducted from taxable pay, so for tax-paying individuals would give tax relief at that individual's marginal rate. However, where income is below the personal allowance, which is currently £12,570, no such relief would be received. And this is in contrast to those paying into a relief at source arrangement, whereby contributions are made net of 20% basic rate tax. The government intended to correct this for pension savings from April 2024 onwards by making a payment of 20% of such contributions to the individual. The payment would be made in the following tax year, so would still mean a cash flow disadvantage for some of the lowest paid. So we're now going to have the first poll of the day, and I would encourage you to participate. So the question is, in connection with the pension changes which I've just outlined, with which of the following opinions do you most agree? Just leave it a few more seconds for people to respond. Okay, let's have a look at the results. So the majority have favoured or agree with the statement, it won't impact on the vast majority, which is a quote from Phil Brown, Director of Policy for People's Partnerships. The second one, no one should be pushed out of the workforce for tax reasons, is actually a quote from the Chancellor. It benefits those with broadest shoulders is Keir Starmer. And the last statement, opinion, is from Julian Hartley, NHS Chief Executive. Thank you for participating in that. So let's move on to capital gains tax. As announced last year, the current annual exemption of £12,300 will be reduced in April 23 to £6,000 before it is halved again to £3,000 in April 24, with the allowances for trusts typically being half of these figures. The soon-to-be abolished Office of Tax Simplification reports that an annual exemption at £6,000 will mean an extra 250,000 people pay capital gains tax, and they estimate that 150,000 of those will complete a tax return for the first time. When the annual allowance drops down to £3,000, That will mean an additional £350,000 people, pay capital gains tax, with an estimated 200,000 of those completing a tax return for the first time. The government is introducing changes to the self-assessment tax return forms for both trusts and individuals, requiring amounts in respect of crypto assets to be separately identified. The changes will be introduced in the forms for the 24-25 tax year. The Chancellor has also announced consultations on both the financial services regulatory framework of crypto assets and the overall self-assessment tax return criteria. So watch this space for changes in the tax environment on both of those. Now turning to farming, payments received under the Basic Payment Scheme, or BPS, are generally taxable as income as a receipt of a trade. Legislation will be introduced to provide that payments received under the lump sum exit scheme, which relate to an eligible claim, are not taxed as income. This will allow the payments to be treated as the proceeds from the disposal of a CGT chargeable asset, as is currently the case when basic payment scheme entitlements are disposed of. Advice should be obtained on whether business asset disposal relief can apply in these circumstances, although in most cases it is currently thought it is unlikely. One change which has already been announced in respect of capital gains tax is for married couples who are separating. Married couples and civil partners are able to gift assets without giving rise to a CGT liability, and in these instances the partner receiving the asset inherits the base cost of the other. Currently, this rule continues until the end of the tax year of separation, after which point the gains are calculated based on market value. This has typically meant such couples facing tax liabilities when they come to finalise the transfer of assets, which can often be a year or two after separation. The government has recognised that tax isn't usually at the forefront of people's minds when they come to separate, and the current rules can therefore be unfair. As a result, for asset transfers from April this year onwards, the no gain, no loss rules continue to apply for the 3 years following separation. Any couples whose separation became permanent during the 2021 or 2021-2 tax years may therefore wish to consider waiting until after April this year to finalise matters, enabling assets to transfer without a CGT liability. Further to talking about the reduction in the capital gains tax threshold and increasing the number of individuals needing to submit self-assessment returns, the government has announced new measures to reduce the number of trusts and estates within the scope of income tax. From April 24, when net income of trustees or personal representatives is £500 or less, it will be treated as zero for income tax purposes. Furthermore, for estates, once this income is distributed to a beneficiary, it will not be chargeable to income tax on that beneficiary. For accumulation and discretionary trusts, the £500 limit will be proportionally reduced where the settlor has a number of current trusts subject to a minimum of £100. Generally speaking, the settlor is the person who transferred assets into the trust when it was created. Interest in possession trusts, settlor interested trusts, vulnerable beneficiary trusts, and heritage maintenance trusts will not be taken into account. Currently, the first £1,000 of income for a discretionary trust, which reduces to a minimum of £200 where the settlor has more than one trust, is taxable at the basic rate and dividend ordinary rate. From April 24, this will be removed, and this income will be subject to the rates applicable to trusts. Finally, it appears there will be more measures to come to simplify tax matters for trusts, as HMRC intend to make changes to inheritance tax regulations during the coming tax year to remove some non-tax-paying trusts from reporting requirements. Moving on to look at a consultation which the government announced in the spring budget, and this is the cash basis reform. The government have said they will consult on reforming the cash basis for the self-employed, which is a simplified way of calculating taxable profits for income tax purposes. Cash basis is where a self-employed individual reports their income when it is received and expenses when they are paid. The government is interested in ways to increase the number of sole traders and partnerships who are eligible to use the cash basis to ensure that more businesses benefit from simplification. The consultation will focus on the 4 policy proposals shown on the slide, but the government will be open to other ideas to increase the number of businesses using the cash basis. Currently, the requirements are that a business must have a turnover of less than £150,000 per year. If you want to use the cash basis, you must make an election. Where the cash basis is used, you can only deduct interest and charges up to £500, such as interest on bank overdrafts. Any charges and interest in excess of £500 are not deductible when calculating the taxable profit or loss for the year. Losses arising from business where the cash basis has been used can only be carried forward to offset against future profits from the same business. These 4 points are what the consultation will be focused on and how these rules can be amended to increase businesses using the cash basis. Lastly, I'd like to look at some miscellaneous points. The government will legislate to restrict charity tax reliefs and exemptions to UK charities and community amateur sports clubs. This affects different taxes across the board. The change will come into effect from yesterday and will apply UK-wide, but there will be a transitional period for some non-UK charities. There is also a contraction in the geographical scope of land and property, which will attract inheritance tax, agricultural property relief. Property located in the European Economic Area, the Channel Islands and the Isle of Man will be treated the same as other property located outside the UK. The changes will take effect from April 2024. The amount of income tax relief available to foster carers and shared lives carers using qualifying care relief will be increased effective from April this year. The annual fixed amount will increase to just over £18,000. The weekly amount for children under 11 will increase to £375, and the weekly amount for children who are older than 11 or adults will increase to £450. I will now hand over to Dominic to provide an insight into business tax changes.
Thank you very much, Chris. I'm a partner at Larking Gowen, advising businesses and their owners on their tax affairs. There were comparatively few measures announced in relation to corporate and business taxes in the budget yesterday. We've concentrated on 2 particular areas where there have been developments, and we will review those areas and set them in their broader context. So capital allowances is the first of these areas, and I'll start with a recap of the continuing features of the existing regime. Writing down allowances remain at the rate of 18% per annum for main pool expenditure and 6% for special rate pool expenditure, and apply to corporates and unincorporated businesses. The annual investment allowance, or AIA, will remain permanently at the current rate of £1 million for corporates and again for most unincorporated businesses. In the context of a group situation or where there are companies that are connected by common control, in certain cases, these enterprises will share one AIA, which will have the ability to allocate as they see fit. So the new measure in the world of capital allowances is that of full expensing. This measure, in contrast to those on the previous slide, is applicable to companies only and will apply from the 1st of April 2023 to the 31st of March 2026 and will apply to qualifying capital purchases. The Chancellor did also say that it was the government's intention to make this arrangement permanent once it was fiscally prudent to do so. Essentially, this is an extension of the super deduction, which for the last 2 years has provided relief at a rate of 130% for certain classes of qualifying expenditure. And this really was a means of trying to encourage businesses not to hold back on their capital expenditure until the planned increase in corporation tax rates to 25% took place. But it's been very successful, and the government want to do something to continue to encourage business investment. Full expensing will provide 100% upfront capital allowances for companies investing in new qualifying plant and machinery. So this is distinct from the rate of 18% per annum, which we previously noted. There will also be a parallel relief at a rate of 50% first year allowance for qualifying special rate pool expenditure. And that's the expenditure that would ordinarily attract 6% per annum. So as with the super deduction, the full expensing allowance applies only to new unused assets. It can't apply to cars, nor can it apply to equipment that is acquired with a view to leasing or hiring it to another person or business. If an asset is sold which has been fully expensed, the 100% of the proceeds of sale will result in a balancing charge for corporation tax purposes. This is not the case for writing down allowances or for expenditure in relation to which writing down allowances or AIAs have been claimed, where the impact of the sale of those assets will be deferred for tax purposes over a number of years, with the proceeds being credited to the relevant pool. If an asset is one in which the 50% first year allowance has been claimed, then 50% of the proceeds will be taxed as a balancing charge. The remaining 50% is deducted from the special rate pool in the usual way. And we note at the end there that the AIA is likely to be preferable, but in cases where the AIA limits are exceeded, so businesses are incurring very considerable capital expenditure, full expensing will provide a benefit. So our poll question on this subject is, will the changes to the capital allowance regime announced in the 2023 spring budget increase the amount which your business invests? Simple yes, no answer, please. Just give you a few moments more. And if we could have the results, please. A considerable difference in opinion between the government, who see this as a means of really driving capital expenditure, and our somewhat more sceptical participants, 91% coming in with a no. Thank you. So the other area that we wanted to highlight was research and development tax reliefs. Now, there have been a number of announcements over the last 18 months, and then there have been further development announced in the budget this year. To recap then, from the 1st of April 2023, as previously announced, qualifying expenditure will include data and cloud computing costs and will exclude certain overseas costs. And the intention here is to bring the legislation up to date and to ensure that the tax relief is focused on UK-based innovation. There are to be changes in the rates that will be applicable. Again, these announced previously in the autumn budget. The Research and Development Expenditure Credit, or RDEC, and this is the relief which applies generally to the largest businesses in respect of their R&D, increases from 13% to 20%, while conversely, the small and medium-sized enterprise R&D relief is restricted. The additional deduction which it provides is decreasing from 130% to 86%. This is part of a rebalancing of the two reliefs by HM Treasury, who are keen to secure best value for the amount which they effectively use to incentivise R&D activity, and potentially also with a view to a full harmonisation of the two regimes, which has been consulted upon. The SME credit rate decreases from 14.5% to 10%, subject to the PAYE NIC cap noted on the slide. This is the amount which SME companies who are loss-making are able to obtain as a repayment where they incur qualifying R&D and surrender their excess loss. From our perspective as a firm, probably the main thing that we look at is the impact on profit-making SMEs. And in this case, the reduction in the rate of enhancement combined with the increase in corporation tax rates produces the figures on the slide. So overall, the effective rate of the benefit under SME for a profitable company is reducing from 24.7%, the 130% enhancement times the 19% corporation tax rate, to 21.5%, which is the new 86% enhancement at a 25% corporation tax rate. In addition, there are some long announced measures to target abuse and improve compliance within the R&D system. So coming on to those, also with effect from 1st of April 2023, I should clarify this generally means for accounting periods beginning on or after that date, there will now be a requirement for new entrants into the R&D claims arena and returning entrants to pre-notify HMRC of their intention to make an R&D claim. Up till now, businesses have had until as much as 2 years from the end of the relevant accounting period in order to submit a tax computation that includes details of the R&D claim. And they haven't had to give any prior notification to HMRC before doing that. Under this new regime, as I say, new entrants and returning entrants who haven't made a claim in the last 3 years will have to provide a notification to HMRC no later than 6 months from the end of the relevant accounting period. So there is a step they will have to take to secure their position a good 18 months earlier than they would have had to previously. And this represents a genuine risk to R&D claimants. Another important measure is the provision of additional information. This is the additional information that will have to be produced with the corporation tax return and the research and development relief claim. Now, for many businesses that operate on a fairly full disclosure basis and provide good details of their qualifying projects and qualifying costs, this may amount to a fairly limited change for them, checking that they are capturing all of the information that HMRC require to see. For other companies that have taken a more minimalist approach to what they have included, this is going to be a sea change. Allied to this, HMRC are going to have powers to remove erroneous claims, and also measures are being introduced to make it clear the senior officer in the company who is responsible for the research and development relief claim, and to clearly identify any R&D tax agent involved with the claim. And HMRC and the Treasury consider that these measures will provide the tools for HMRC to address some of the error and in some cases fraud that they consider has taken place within, in particular, the SME R&D space over the last few years. So moving on to the new development from yesterday's spring budget, there is to be an additional relief for R&D intensive SMEs. R&D intensive in this case will mean a company with R&D expenditure of at least 40% of its total expenditure. And this might create something of a worrying cliff edge whereby companies who are around that area are really keen to demonstrate that they are indeed spending 40% and not 39% or 38%. The SME credit for these companies will effectively remain at 14.5%, albeit obviously based on a lower enhancement of the 86% rather than 130 before. So it's effectively providing a middle way for companies who were previously claiming under the SME regime, claiming a repayable credit and have seen the value of that reduced. But if they are knowledge intensive and loss making, they have this possibility, which it's not as good as what they had before, but it's better than what will apply to other SMEs. The impact of this is that from the 1st of April, the cash repayment increases to £27 for every £100 of qualifying expenditure for these R&D intensive companies, which we think are essentially going to be startups who are yet to get to a point where they have commercialized their product or service. And from 1st of April, again, an SME that isn't R&D intensive is able to surrender R&D losses for a cash sum equal to £18.60 of every £100 qualifying expenditure. There's also an extension of certain cultural sector reliefs that's been announced in the budget yesterday, an extension of the 45% and 50% rates of relief for non-touring and touring theatres, museums, galleries and orchestras. This was due to have reduced from 1st of April this year, with a further reduction in a year's time. However, the reliefs have been held at these rates for a further 2 years, a welcome announcement for some of these operators who were so badly affected by COVID and now attempting to restore their previous position. So we'll close this corporate and business tax section with an area which we haven't actually had any developments in the budget yesterday on, but where the impact of changes which have been announced over the last year or so will now start to come into direct focus from the 1st of April. This is the perennial question for owner-managed businesses of whether to pay a bonus or a dividend to the owner-manager, which is the more efficient route, having regard to personal and corporate tax consequences. Now, the sort of changes that will have impacted on this are the fact that for many companies, the corporate tax rate will be going up to 25%, those with profits of over £250,000 broadly. And also the fact that the national insurance contribution increases of 1.25% on the employees and employers' rates were removed last year, but the additional 1.25% increase to each of the dividend income tax rates has been retained. So these factors do, in many cases, change the picture from 1st of April. We've chosen an example here where the director or shareholder is an additional rate taxpayer, again, more likely with the reduction in the threshold above which additional rate is paid. We're looking at a company paying tax at the 25% rate, so not the smaller businesses that will pay at 19% or 25% less marginal relief. and in a case where the intention is to extract a further £60,000 or so of net cash to the owner-manager in the current tax year. So we'll start with the right-hand column, I think, which shows the position in relation to dividends. We're looking at a dividend of £100,000 paid out by the company, and the tax on that at 39.35% results in a net cash amount retainable by the owner-manager of £60,650. Now, of course, he will receive the £100,000 and have to account for the 39,350 through the self-assessment process in due course. Now, if we were to replicate that in these circumstances by way of a bonus, and in this case, we're looking at replicating the amount of net cash that is left with the owner-manager, we would have to pay a gross bonus of just over £114,000. These are the figures in the left-hand column there, highlighted in green. You can then see the impact of 45% additional rate income tax and the 2% employees' national insurance. And this brings you down to the same figure of £60,650 of net cash. So to the employee, that's the same position. The question is, how much does the company have to expend to achieve that? In this case, the gross bonus, we've said, is just over £114,000. There's then the employer's national insurance contributions on that. But then there's a corporation tax deduction in most cases for the cost of the gross payment plus the employer's national insurance. And that's more valuable now, given that the corporation tax rate at which this is saving, in the case of our example, is now 25%. So actually this reverses to, in some cases, the long held position whereby it's normally been more tax efficient to pay dividends. And you can see from this that the cost of the company is under £98,000 in this case versus costing the company £100,000 with a dividend. So what this really does mean is that something which we've been able to take in many cases for granted will now need to be considered quite carefully. Often the outcome will be different, but clearly this is only based on a specific, not atypical, but a specific set of circumstances, and there is a need to consider each case on its own merits. And with that, I'll hand over to Gillian McGill for a VAT update.
Thank you, Dominic. I'm Gillian McGill. I'm a director in the VAT department, and I work with businesses and not-for-profit organisations to help them navigate the world of VAT. So first of all, what stayed the same? As announced in the autumn statement, the VAT registration threshold of £85,000 remains frozen, and that has been set at that level since the 1st of April 2017. So it's just one example of the fiscal drag that has been built into the tax system over recent years. There's been no changes in the VAT rates. They stay the same as they have been for a number of years, but there has been some changes in how those rates are applied to certain sectors. We turn first to the medical sector, where we have an exemption that applies to services performed or directly supervised by certain registered medical professionals. Now, that exemption has specifically excluded where supervision is provided by a registered pharmacist and meant that those sorts of services were brought into the standard rate of VAT. From the 1st of May 2023, pharmacists are now recognised as a qualifying individual who can provide exempt supervision for medical services. Now, that might well benefit community care services who will see a reduction in their cost. We have patient group directions, which are local arrangements that permit the issuing of defined drugs to a class of patients with particular conditions. So, for example, that might be a community walk-in service or a seasonal flu clinic. Now, these wouldn't automatically fall within the definition of prescriptions that can be zero rated because they're not written for specific individuals. So they're currently standard rated. This change now brings patient group directions into the zero rating, potentially reducing costs for community care providers. Now that we're operating in a post-Brexit world, the government has the opportunity to tweak the VAT legislation. And one of the areas that that's happened in was with respect to the financial services exemption. The proposals are now to exempt special investment funds by bringing in more clarity as to what will be exempt and what would not be exempt. The suggestion is to move from specifying within the legislation the specific types of funds that qualify as special investment funds and moving towards a more principles-based approach with the aim of ensuring that funds operating in a similar manner and competing for the same investors are then taxed equally for VAT purposes. We've also been told that there will be further consultation in the financial services sector in response to industry working parties. We've had a couple of environmental measures announced yesterday. We have the deposit refund scheme, which is going to be introduced and legislated from the 1st of August 2023. Now, this is aimed at the drink supply chain to encourage reuse of containers, bottles probably. The idea is that a deposit would be charged plus VAT at each point in the supply chain, and then that VAT would need to be reversed when the bottle is returned at each point in the supply chain. To simplify the administration of this, the government has now announced that only the manufacturer or the importer who makes the first UK sale of the container accounts for VAT on the value of deposits that are not returned. Now, bear in mind that these are the same businesses who will have had to deal with the sugar tax introduction in 2018. They're going to have to do another round of changes to their administration to implement this. Announced last year's budget was that zero rating would apply to the installation of certain energy-saving materials when they're installed in residential accommodation in Great Britain. There's also a reduced rating for Northern Ireland properties. This consultation that's been announced aims to bring up to date the list of qualifying items that are treated as energy-saving materials because of the advances in technology in this area, hopefully expanding the range of that zero rate relief. There is also a suggestion in the consultation announced that relief might be extended to buildings used for relevant charitable purposes, being those that charities use, which will be a very welcome extension of relief here. With the lack of affordable housing around in the country, there's a suggestion that more people will be self-building their own home. And we have a poll now to ask how popular you think self-building is. Thank you. Okay, so the answer apparently is 1 in 3 people looking at building their own home. So probably slightly braver than the 1 in 10 that has been suggested by the poll results. Thank you. So talking about people building their own homes then, the DIY house builders scheme is in place and has been for a number of years, enabling self-builders to recover the VAT that they incur on building materials, with the aim of putting those people broadly in the same position they would have been in had they purchased their house from a developer. Currently, original hard copies of all invoices have to be submitted to HMRC within 3 months of achieving practical completion. And the changes announced confirmed that will extend the time limit from 3 months to 6 months, taking away some of the pressure by moving on from when we get to practical completion, and also moving from reliance on post and paper to a digitalised process as part of HMRC's overall drive to move to a digital world. We've also got an investment in HMRC, which is not a VAT specific measure, but those of you who have been at the mercy of HMRC's delays will know that the department does need a lot of investment to keep it moving on. The good news is then is that £47 million of investment has been announced, specifically in the debt management capability of HMRC, and also noting that the time to pay service may benefit from this, perhaps a sign of the times and the impact of the cost of living crisis and people's ability to pay their tax on time. I'll hand back now to Sally to take some questions.
Thanks, Gilly. I'll just wait for Chris and Dominic to join us, because I'm sure there looks like there's some questions that I won't necessarily know the answer to. So, right, so if anybody else has got any questions, then add them into the box and we'll try to get to them. But we have had some submitted, so I will go to one for you first, Chris. So somebody turned 75 last year and they've recently just had to pay a pension lifetime allowance charge. Do you think it's going to be possible for them to get that money back from HMRC?
Interesting question. I think the short answer is no. There's no sign in the material we've seen so far that the relaxations which I talked about were going to be retroactive. The question's tax charge arose at a point when the legislation was different. So there doesn't seem to be any way of getting that money back. That's probably unfair, but sadly no one ever said tax had to be fair.
Thanks, Chris. Okay, so next question will be for Dominic. Is the annual investment allowance effectively redundant for the next 3 years now that the full expense relief is being introduced?
Thank you, Sally. I can completely see where the question is coming from with that. It's probably helpful just to point out there are several ways in which the annual investment allowance will still be highly relevant over the next 3 years. For a start, I think we noted that the full expensing relief will only be available to companies. So for unincorporated businesses, that won't apply. Annual investment allowance will still be very relevant for them. We also noted, I think, that there are some assets which are outside of the scope of the full expensing relief, but they may be in the annual investment allowance. So examples of that would be assets that are required for hire or second-hand assets. So again, there it will capture assets not within the full expense relief. I think also the full expense relief and 50% allowance that goes along with it, with the annual investment allowance, if it qualifies, it will secure 100% relief. So some of those assets that would be special rate pool that would only attract 50% under the new expensing regime will qualify for 100% under AIA. So it will be beneficial there as well. And I think finally, there's probably a reduced instance of balancing allowance clawbacks with annual investment, whereas with the new expensing allowance, there's an immediate clawback through a balancing charge in the event that one of those assets is sold. There are several good reasons why AIA is still alive and kicking, but totally agree with the questioner that its impact is going to be less significant overall for the period that full expense relief is with us.
Thanks, Dominic. I've got another question which probably could go to you or Chris, depending who wants to take it. Is there a change in the bands for dividends? Chris, do you want to take that?
Yeah, happy to. Short answer again is no. There are no announcements in yesterday's speech or the material that was released afterwards. So basically, the tax rates and bans for dividends were as previously announced.
Thanks, Chris. Don't want Julie to feel left out, so we have a VAT question in here as well. So with the extension of the DIY house builders scheme, will it apply to both new builds and conversions?
Yes, it does. That's right. So both constructing your own home or converting from a non-residential property, a barn being typical, to a residential property will also be able to benefit from this extension from 3 months to 6 months to make a claim to recover VAT. That does, of course, require that you meet all of the conditions that are in place to make a DIY claim, having planning consent being the key one, that the resulting property meets all the definitions for VAT of what is a residential property, which may not all be what the man on the street thinks qualifies as a residential property, and that the home is going to be lived in by either you or a member of your family as their house. But yes, that 6 month extension to the time limit's very welcome indeed.
Thanks, Julie. Another question for you, Dominic. I think there's obviously quite a lot of debate around annual investment allowance versus the new expensing rule. Somebody's asked, why would somebody prefer AIA over expensing?
I think we probably covered most aspects of that question with the previous very similar question. I guess just to add something, why would one prefer the expensing rather than AIA? Well, I think in that case, that's simply where you've got companies who are incurring more than the £1 million of expenditure, which will fit within AIA. The expensing regime is completely uncapped. So, if you incur £10 million of expenditure across your group, if it's qualifying expenditure for full expense allowance, you will be able to claim that. As I say, for AIA, there's still several reasons, including availability to non-corporate entities, probable less likelihood of balancing charge, assets that qualify for it which don't qualify for full expensing, and also assets qualified at 100% rather than 50% under the parallel full expensing regime.
Great, thanks, Dominic. You'll be pleased to hear that's all the questions that we've had. So I think that brings the webinar to a close today. So it just leaves me to thank everybody for attending. If anybody does think of anything else they want to ask us, say you can contact your normal point of contact at Larking Gowen, or there is the specific email address on the budget on the screen. I should also thank the team for putting the webinar together following the announcements yesterday. Luckily, there wasn't lots of content, so we weren't up till the early hours, but lots of work goes in behind the scenes as well to pull this together. So thank you for those. So that is it from us. So I hope you all have a good rest of the day, and thanks again for joining.